All right, well, it's right at noon, so we'll go ahead and get started with our webinar today. Thanks everyone for joining. Hope you're staying well and safe during this time. My name is Sue Rogan, and I'm the Director of Strategic Partnerships with the Cash Campaign of Maryland. In case you don't know, CASH stands for Creating Asset Savings and Hope, and we are a nonprofit that works with different partners, such as Brendan today, to provide programs and services to help build the financial well-being of individuals and families in Baltimore and across Maryland. One of which is financial education classes. So we're really excited for you to join us today. And I am really grateful to have Brendan McKay with us today for this webinar. Brendan is the owner and senior loan officer of the McKay Mortgage Company, which in the past 3 years has funded over $170 million in residential mortgage loans. And besides that, Brendan really finds purpose in educating consumers and demystifying the mortgage financing process. So we're lucky to have him here with us today to talk about what is the latest and the assistance programs that could help people if we have concerns about paying our mortgages during this crisis. So Brendan, thank you very much for joining us today.
Yeah, awesome. Thank you for having me, Sue. And yeah, I appreciate it very much. And I'm going to go ahead and share my screen so you guys can look at what I'm looking at. And Sue, if there's any questions while I'm going through this, just feel free to interrupt me, and I'll be happy to answer questions live as I'm going through it.
Okay.
Um, what we're generally going to be talking about today is mortgage options during COVID-19, and the government and lenders and mortgage servicers have made a lot of changes to do their best to help homeowners with everything going on right now. And we're going to review and get into specifically what's happening and what is and is not possible. The biggest overlapping change has been the CARES Act relief, which really is two main things. There's a foreclosure moratorium, and lenders and mortgage servicers cannot foreclose on a home for 60 days after March 18th. That is a federal law. Governor Hogan made an executive action, and specifically in Maryland, it's more overlapping than that. All foreclosures are stopped until further notice, basically. So nobody can foreclose on a home because of lack of payment until Maryland says it's okay again. The second part of that is the right for homeowners who are experiencing financial hardship to enter mortgage forbearance. Mortgage forbearance basically means putting your payments on pause or reducing or delaying them in some one form or another. It does not mean that the payments are forgiven or they're skipped, or you're not going to have to pay them in one form or another eventually. It also doesn't mean that you can just stop, not tell anyone, stop making your payments and you're okay. It is something that you need to get set up with your lender, and we're going to talk about different options for stuff like that and resources that you can use to figure out the best way to do it for what makes sense for you. There are really three types of mortgage forbearance, three main types. You can skip payments due immediately after you can skip payments and they're due immediately after the forbearance period. You can have a payment reduction worked out, or what's really better called is deferment. And we're going to talk about what the three of those mean right now. So if you skip your mortgage payments and they're due immediately after forbearance, here's basically what that means. Say your mortgage payment is $2,000 a month, and you contact your mortgage lender and say, hey, I'm having hardship, I need to enter a forbearance program. And they say, okay, you can skip the following 3 months. So let's say it happens now. You don't make June, July, or August, okay? But under this program on September 1st, you owe a total of $8,000. You have to pay the September payment, which is $2,000, and then the 3 payments that you missed of $6,000 are due immediately. This is obviously what most people, what they were hoping for. There's not a lot of people that this really does a significant amount of benefit for. But it is something that's out there for a decent amount of loans. And up until recently, this is what, if you just clicked a button on a website and entered forbearance, oftentimes this is what would happen without you really knowing it. It's important to note, though, since everything first rolled out, some refinements to the CARES Act were made. And this option is simply not even on the table for any mortgage that's federally backed. That's Fannie Mae, Freddie Mac, FHA, VA, HUD, and USDA. That's about 50% of the mortgages out there. Finding out whether your loan is federally backed or not, you really have to call your lender or servicer that's the easiest way to find out specifically. Some general guidance on that, though: if you did your mortgage through through a large lender or bank, or you did an FHA loan or something like that, it is probably a federally backed loan, not definitely. If you did your loan with a small local bank, it might make it less likely. They keep their own loans and they're not always federally backed. But that's a very loose guidance and is not to be taken to the bank by any means. The other type is mortgage payment reduction. So if your payment, once again, is $2,000 a month and you call your lender and work it out with them and they say, okay, over the next 3 months, your payment is going to be reduced to $1,000 a month. So we'll cut it in half for you for 3 months to kind of lighten the load a little bit. But after that period, you have to pay back what you skipped, or the missed portion, over a period of time of, let's say, 12 months. So in this example, you would make $1,000 a month for 3 months, but then after that period is over, your $2,000 payment would become a $2,250 payment, $2,000 for the normal portion, and then $250 to catch up the $3,000 that you missed over a 12-month period. Whether your reduction is over 3 months and your payback's over 12 months, there's no set guidelines on that. Every lender is acting a little bit differently when they offer this this type of assistance. So you want to make sure that you understand exactly how much your payment's going to go up by when it does increase. And then deferment is the third type, and this is what when people hear forbearance or mortgage relief, this is generally what most people are hoping for in their mind before they call, but it's not always what's actually going to be available. There are some jurisdictions, DC, for example, has recently made this requirement for mortgage lenders, that this is what they offer. And I know there is some discussion in Maryland about something similar happening as well. But in the same confines of the example that we've been talking about, your mortgage payment's $2,000 a month, and you don't make mortgage payments at all for 3 months. Then on month 4, you just go right back to $2,000 as normal. But the $6,000 that you didn't pay over that 3-month period doesn't just evaporate into thin air. The missed payments become what's called deferred principal. So they will sit there. You'll see it on your mortgage statement from that point forward. You won't make interest payments on it, or principal payments or payments at all on it. But when you either pay the loan off, and however many years that is, at that point, $6,000 would be due immediately. What would really happen for most people is that when they sell their home, or if they do refinance at some point, that $6,000 would be due at that point. So it would be tacked on essentially. So it's still not skipped entirely, but you really are kicking the can down the road, and it does give you complete relief for the time that you need it. It's important to know for all of these deferment options that you do have to prove, or you do have to have financial hardship to be eligible. Now, the bank standards when you apply for verifying financial hardship are in most cases going to be essentially nothing. You just attesting to it. But they can come back afterwards and make you actually document it. And I'm not telling that to scare anyone that needs the deferment, but there was a big wave, at least in the beginning, of people thinking, oh, like no mortgage payments, I'm good to go. And people that did not have a lapse in their income, just using it as something to take advantage of. And that's not, obviously has its own moral problems with doing something like that. But it definitely can come back to bite those people, because if they can't document it, what they did was fraud, and that is obviously bad. The other potential downside to taking advantage of these deferment programs is it could have a direct impact on your ability to refinance your mortgage in the future, either immediately or down the road. Lenders are still figuring out how they're going to treat situations where people apply to refinance and have their current mortgage was deferred at some point. But the guidelines are being rewritten on this. And the most common that I've seen is that you would have to wait some period of time, up to 3 months to a year. I've seen as long as 5 years before the lender would consider refinancing a loan that was deferred during this time. But there's also discussions of them continuing to make sure that there was true hardship and everything's good now, because they just want to make sure that if they're going to write the loan, that the payments are going to end up getting made. So keep that in mind as well, which is very relevant, because right now interest rates are as low as they have been in an extremely long time. So being able to take advantage of low interest rate options is also going to have its own cost savings, and could be extremely important to you. So we're going to talk a little bit about how to analyze different options, because refinancing is something that almost every homeowner is probably already actively considering and having those conversations. And if they're not, there should be. So it's a good time to kind of bone up on exactly what you're looking at and the numbers and what should be important to you. Aside from the obvious that most loan officers are going to talk to you about, there's a couple things I do want to discuss that aren't always brought up, but are extremely important when you're looking at refinancing options. First, you need to focus on the interest savings, not the reduction in payment. Usually when people refinance and they talk about it, oh, my payment dropped by $500 a month, it was so great. But that doesn't mean that you saved $500 a month. It means your budget opened up by $500 a month, and that's important, don't get me wrong. But you need to go into this with eyes wide open and know the difference between savings and cash flow. So you want to look at interest savings in terms of dollars, not percentages, interest rate, because that also won't always tell the whole story. What I mean by that is a 0.5% interest rate drop on a $500,000 mortgage is a very, very different thing than a $500,000 interest rate drop on a $200,000 mortgage. They might sound like they should be relatively the same, but they're not. The real dollars saved on a $500,000 loan are going to be significantly more than they would be on a $200,000 loan. And it's like, well, yeah, but it's all relative, right? But it's not. The reason is because the closing costs on those two refinances are going to be extremely similar. An appraisal still costs the same. The lender is probably going to have the same underwriting fee. And the title attorney that closes the refinance is going to have the same fee. Those are flat fees. So the costs are the same, but the benefit are not. So you really want to look at real dollars and not just be like, my interest rate is dropping by this. There is no golden rule that you should only refinance if your interest rate drops by a certain percent. It is different for different loan amounts. And there's other things that factor into it, but that's the biggest thing. Pay attention to the closing costs, especially the lender related fees. Third-party fees like the ones I listed, like the appraisal and settlement attorneys and title insurance, those are kind of going to be the same no matter which lender you work with, but lender fees are going to change drastically. So pay close attention to discount points, which is badly named as not a discount, it is an expense. Processing fees, origination fees, underwriting fees, upfront mortgage insurance, which is on FHA loans, which is not going to change from lender to lender, but it is a cost. It's financed into your loan amount, but it's a cost. Not today, but it will be when you sell your home. And funding fees is a different name for a very similar thing that's relevant on VA loans. Because like I said, refinancing is a cost benefit decision. The cost is the closing costs. Those are a sunk cost. But the benefit is the interest that you save over time. So you want to look at how long it's going to take the interest savings to recoup the closing costs. How long that should take, that recoup period, I generally don't think it usually makes sense if it's more than 2 years. Every situation is different. If you are dead set positive you're going to be in your home for 15 or 20 years, it still would make sense, of course. It could be as long as 5 years. That being said, life is unpredictable, and you really don't want to be setting yourself up in a situation where you need things to go exactly how you plan them to for 5 years for it to be a profitable decision. That's not really the way you should be looking at this. You don't want to be in a situation where refinancing could be a money loser for you. Also, when looking at escrows or prepaid interest, you can essentially acknowledge they exist when you refinance and that those are things that are going to be collected, but they are not a net cost. Your interest is either going to be paid on your old loan if you don't refinance or on your new loan if you do. And escrows are the account that your taxes and insurance are paid out of for your mortgage payment. And taxes and insurance are obviously going to get paid no matter what. Refinancing does kind of make some of those bills maybe due sooner by a month or two, essentially. But when you're looking at it, don't take it into account as far as like when you're doing the cost benefit analysis. I did want to look at one quick example of some of the aspects that I was talking about. So in this example, I'm going to use my mouse a little bit. The home is worth, let's just say $400,000, and right here is the current mortgage. It's a $300,000 balance. The interest rate is 3.875%. So here's the principal and interest payment and the property taxes and the homeowner's insurance. So your total monthly mortgage payment is $1,954. In this example, the person is 5 years into their mortgage. They bought the home 5 years ago. and they've been making payments on their mortgage ever since then. A quick trap that a lot of people can get into is go, okay, I'm going to refinance, and they look, this is a ballpark of what interest rates are right now at 3.125%. That's awesome. That's great. Principal and interest payment goes down by this. Taxes and insurance are going to stay the same. And they're like, oh my God, that's amazing. I'm saving almost $300 a month, $275 a month. That is fantastic. But your payment goes down by $275, but it's not actual savings, because what's happening here is you are adding 5 years onto your mortgage. And that might be okay, but you want to make sure you know what is being added on and what is actual savings. So one thing that can be helpful to do is you look at a 25-year mortgage. It doesn't mean you need to do a 25-year mortgage, but by looking at that, it will show you how much you're saving in interest. And this tells it right here, right? On a new 25-year mortgage, the payment goes down to $1,833. So it's between that and this, it's $121 difference. And that's still great. That doesn't mean that it's not worth doing necessarily or anything like that, but it tells us how much money we're actually saving from a large perspective, right? Like, you'll stay on the exact same pace on this example. On this one, your payment will go down by more, but your principal will drop slower than it would be if you stayed on the same pace right now. And at the end of looking at this, you still might decide that this is the best option for you because of budgetary constraints. You really can use the difference between these two numbers in a positive manner, whether it's paying down credit card debt or saving for student, for college, or saving for retirement, or replenishing your emergency savings. All these things are good positive things, but you don't want to just go and look, oh, look, my payment went down by this much, and blow the extra money and have no idea where it went. So that is something you want to analyze. And even if you're 3 years into it or 4 years into it, you can look at what a 27-year mortgage would be. You might not technically be able to do a 27-year mortgage. You do a 30-year, and then you make additional principal payments, and it essentially turns it into a 27-year. And it gives you all the same information that you need to make an educated decision. Closing costs. So this is the sunk cost I referred to. You will collect a new escrow account. I'm not going to, it is a little complicated on escrows. I'm not going to get too far in depth into it right now. But the most important thing to know is, if I explain it quickly, is that your new mortgage, you pay into your escrow account every month. That money's put to the side, and your lender pays your taxes and your insurance out of it. This is how most mortgages are set up. Some people pay it on their own, but most of them you pay through your mortgage and smooth it out. And when you refinance, typically you cannot just move that pot of money over to your new mortgage. A new one has to be collected at closing. And then after closing, you will literally get a check in the mail from your old lender for the remaining balance of your escrow account. That will wash out, in this example, the majority of that $3,412. The rest of it, when you refinance, you also essentially make a mortgage payment at closing. 30 days of interest are collected at closing. And because that happens, you do not make a mortgage payment the month following closing. So let's say you refinance and you close in June, you would not have a July mortgage payment. Your first new payment would be in August. So between getting the refund from your old lender and between not making the out-of-pocket mortgage payment the following month, the money that's collected for the escrow on your new mortgage is washed out, it's neutralized. So it is money, you're kind of floating it in a sense for a couple months, but it does wash out, so it's not a net cost. And the only other thing I wanted to make sure to show, this is a website called forbearancereport.com. And it is an amazing resource. It's the best resource that I've found that's comprehensive and has all the information that you need to get as specific as you'd like on looking into forbearance options on your specific situation. It was actually created by 2 mortgage brokers that I know personally in California. They are not only incredibly knowledgeable, but really, really good people. And they do this kind of stuff. They just are big on consumer advocacy, getting people as informed as possible. So they've compiled as much information they can and put it on this website, forbearancereport.com. I'll put it in the chat in a minute. One of the first things that's incredibly helpful for consumers is this list right here covers pretty much 90% of the major mortgage servicers, probably higher than that, in this country. So if you did your loan and you didn't do it through a small bank, a small local bank or a credit union, it's very likely that one of these companies services your loans, and you can go right to these links and get direct information for how these companies are handling forbearance and what options they're presenting. There's a really detailed FAQ down here. And also within these links, there's a comment section that people have been leaving and describing their experiences with getting forbearance with these companies that can be helpful for you as well. So definitely check that out if you're looking for more information. That really covers it for me. I always end every meeting I do with a picture of my kids because I love them very much. And Sue, I don't know if there are any questions I could answer.
There haven't been any questions in the chat yet, so please, everybody, if you have a question, go ahead and put it in the chat. Oh, your kids are gorgeous.
Thank you.
But I was wondering if you could reiterate or kind of go back over again which mortgages were covered under the CARES Act and those different options that you mentioned in the beginning.
Yep. So any mortgage, the CARES Act covers any federally backed mortgage. Generally speaking, from a broad sense, not generally speaking, which would be any loan that was a Fannie Mae, Freddie Mac, FHA, VA, USDA, and HUD, which HUD loans are rare, but they exist. So the rules of the CARE Act overlap any of those mortgages. If your loan is not federally backed, it means that not all the CARES Act might apply, but frankly, all of the banks and everybody's on board with this stuff. So they should be offering options. And above that, not only do all these lenders required to offer forbearance options because of the CARES Act. The one where all your payments are due as soon as forbearance ends is not something that those lenders or services are allowed to do. They have to offer the payment reduction or the deferment option they're required to. Does that clarify?
Yeah, I think that makes a lot of sense. How would someone be able to find out whether their mortgage is federally backed or not?
The best way is to call your mortgage company, call your servicer, and directly ask them the question. There's some other ways to go about it. You could go through your closing documents from when you closed on your loan, and you could look at the note would tell you whether it was or not. And there's a bunch of other documents in there that it would tell you whether it was an FHA loan, for example. If you're a veteran, you probably know that you have a VA loan or not. On FHA loans, because a lot of people don't know what kind of loans they have, and usually a question I'll ask them: what was your down payment when you bought your home? If your down payment was 3.5%, it is extremely likely that you had an FHA loan. If your down payment was 3%, it's extremely likely that you had a conventional loan, a Fannie Mae or a Freddie Mac loan. If your down payment was any other amount, it can be difficult to say. If your down payment was 0% and you live in a rural area, it was probably a USDA loan. Those are some loose guidelines that you can definitely find examples where what I just said is not true, but more likely than not, you're good.
Okay, thank you. And I also want to let everybody know that the Maryland Department of Labor, the Financial Regulation Division, has information on their website that I'm putting in the chat box. And Brendan, I put in the forbearancereport.com in the chat box as well.
Awesome.
So the Financial Regulation Division also has information about state relief or regulations that need to be followed. So please take a look at that as well. And I had another question that people may be thinking of. You talked a little bit about the potential for refinancing.
Yeah.
So if people are experiencing a difference in their income right now, what would lenders be looking for? Are they looking for last year's tax return that would show income from last year? Are they going to look for verification for income of this year? How might a change in income impact the ability to refinance?
That's a really good question, because there has been a lot of changes in that department. Lenders are understandably much more vigilant about verifying income and active employment than they would be in normal times. So If you are a W-2 employee, meaning you're like, you know, a salaried employee or hourly, and receive a regular income, usually they're just going to be looking at pay stubs in your last 2 years W-2s. Now, they may ask for the most recent pay stub before your closing date, where normally it's like, as long as it's within 3 months, we're good. They might want the one right before closing as a way of verifying not only that you're currently employed, but your pay has not decreased, because you're not only seeing obviously people getting furloughed and laid off, but also you're seeing salary reductions. Like I had a client recently where her income was cut by 10%. Company-wide, they cut everyone's income by 10%. And that wasn't a problem. Actually, the lender was fine using a reduced income to qualify her, and we still qualified. It wasn't an issue. You may see some lenders not feel that way. They might be like, that is, you know, a sign of instability and we can't use that income to qualify. If there's two borrowers and you still qualify off the other person's income, that's totally fine. What the biggest change you're seeing is typically lenders would do something called a verification of employment, where they would call your HR department or your manager or supervisor and verify your employment before closing verbally. Just a quick phone call. It's pretty standard. And usually it would be anytime 10 days within closing. Lenders are doing it at least, the window is shrunk into the max 3 days before closing. Some lenders are requiring that it's done the day of or the day before closing. And on a refinance where you close and the loan funds 4 days later, they will verify it before they fund that loan. So something that we've been proactive about, and if you're refinancing, I would recommend you have your loan officer make sure they're doing, get them direct contact information, phone number and email for someone in HR, or even better, your direct supervisor. A lot of companies have protocols, say, no, you have to do it through this online website, which if that website, the work number is the most popular one, if it is not updated recently enough, they may not take it. I will tell you though, protocol aside, most companies understand what's going on in the world and are willing to break protocol. I've had, you know, military members have their direct commander verify employment. I've had it at federal agencies and as well as large corporations. People are pretty reasonable about what's going on. Self-employed borrowers, 2 years tax returns, but you're going to be scrutinized heavily too. A lot of lenders are just docking self-employed borrowers' income. You're not really allowed to do it from one industry to the other and make those kind of rules. You have to do it broad. But they are getting docked, and additional requirements like they want to make sure you have extra money in reserves. If you're self-employed is a very common thing you're seeing. So expect enhanced requirements for that kind of stuff.
Thank you for that. We do have one question here.
Great.
Is forbearance or deferment affecting refis, given that normally 12 months of payments is usually needed?
Yep, and they absolutely are. You don't always need 12 months of payments to refinance. If you bought your home 3 months ago or 6 months ago, you can definitely refinance. So that's a little of a misunderstanding. But if you do go into forbearance and then at some point in the future try to refinance that mortgage, even if you're back to making normal payments, and even if you've caught up on any deferred principal, you are probably going to experience problems refinancing that loan. It's still shaking out exactly how it's going to work. My best educated guess is that you would probably have to wait a year before being able to refinance that loan in favorable terms. There's definitely going to be lenders that will do it sooner, but it won't necessarily be the terms that you'd like. That is not set in stone right now. Lenders are still figuring this out, and it's starting to come up. People are trying to refinance, and they're definitely not letting them refinance right now. But there is no industry standard on a waiting period yet.
Thank you, and thanks for the question, Dan. One last question for you. You talked about these different fees that are showing here. I'm just kind of curious overall. I've heard different things from different people. Are any of these fees, processing, origination, are they negotiable, or are they just set and that's it?
They are. With some lenders they are, and with some they're not. I mean, I can speak personally. We at McKay Mortgage doesn't have processing fees or origination fees or underwriting fees. I typically recommend refinancing without discount points. That is, discount points is kind of controlled by the interest rate. So let's say in this example I showed you a 3.125%. This is an example with no discount points. If you wanted to do 3%, you would have discount points on that. By you're essentially buying the interest rate down. You're paying more upfront to have more benefit in the long term. Some lenders will just show you quotes with discount points like it's the normal quote. I think the baseline should be one without quotes, and then you kind of talk about it from there. So it's negotiable in the sense that you can control it, but whether they're going to waive those fees or anything like that, I mean, anything's negotiable, but they might say no. The upfront mortgage insurance and on FHA loans and VA and funding fees on VA loans is absolutely not negotiable. Those are just features of the program.
Okay.
Yep.
Brendan, thank you so much for all this great information today. We
Got
really
it.
appreciate you taking your time to do this. And thanks everybody, please, for attending this webinar. If you have any other concerns, there's information on mdcashacademy.org, both on these housing. I'll actually add the forbearance report on there as well, so we can make sure that's there. And if you need any assistance with legal concerns around your mortgage, there's also a section on Cash Academy that has the legal resources that are available now. So please check that out for more resources and more webinars. And I hope everyone else has a great rest and very safe part of your day.
So yeah,
Thanks.